Joining us now to perhaps try and make sense of these inflation numbers, make sense of the market malaise that we have been seeing. Robert Luna, CEO and Chief Investment Strategist at SureVest Investment Management, joining us from Newport Beach, California. Rob, thanks so much for being here. Just firstly, can any investor with any kind of confidence invest in these markets over, say, the next week, 2 weeks, when you've got all of this back-end activity going on?
Well, if you're talking about confidence in terms of having 100% certainty of the direction of the market, absolutely not. But I don't know that that's any different from any other time right now. But obviously, you mentioned a lot of great points in terms of short current rallies right now, the volatility that's expected. We saw, one thing you mentioned, though, this is only the 5th time in history that we've seen this type of lows turn into highs. Key reversal day is what we call it. And one thing that we have not seen that gives me a little bit of optimism during all these types of trying to put them in a bottom over the last 3 to 4 months is a day just like this, where you close up after being down significantly on bad news. That is a little bit of a change that could get psychology to change. But as you pointed, tomorrow, especially consumer sentiment, retail sales, and all the big banks starting to report, it's going to be very telling to see how we finish tomorrow.
Indeed. Are you in the camp that believes that there's more downside from here? 20% is the number to ignore?
Yeah, no, I don't think there's another 20%. I think, I don't know that we're too far off of consensus, though. I think the numbers, when you look at where we're at in terms of earnings cuts that we believe still need to be done if we're going to go into a recession, which we think we're headed there, the market probably needs to be at about 3,000 to 3,100. That being said, a lot of people are calling for that number. And when you're talking about 32, 3,300, 3,500, it's very, very hard. And that's what we've been telling clients, to pick that exact bottom. Was today the bottom? Potentially, potentially not. But I think that's, as an investor, why you need to use risk management in markets like this, dollar cost average, because these markets move so quick to where you could be up 15, 20% in a month, 2 months, and you don't necessarily want to miss that.
And that would be driven by, for the markets to rebound meaningfully from here? What would be the catalyst?
There's a tremendous amount of money on the sidelines. Every single report we're reading, retail investors, if you're looking at money managers right now, the consensus right now is that we're going down. We're going down to that 3,000, 3,100 number. Everybody's very scared. There's a lot of information out there that's very ambiguous. So when you get so many people that are on the sidelines, that's a lot of cash that's left to come in and push things up. Short covering rallies, money managers worried about underperforming. We've seen this happen before, and bear market rallies, and that's what this could be. We saw one earlier this year, could be 15 to 20% in a matter of minutes, even during bad news.
But that's the thing, Rob, because if you're thinking as an investor, it does make sense to sit on the sidelines, and perhaps sit on the sidelines even for the next 6 months, because if you're thinking about within the context, we have all of this volatility, all of this crazy back-end trading. Q3 earnings coming up. Yes, we're expecting, perhaps even a little bit of a beat, but you could get that terrible Q4 guide. But then you also have the tax loss selling in Q4, and you would expect that would be pretty significant considering all the losses people have taken in order to just try and, recoup some cash. So can the case be made that perhaps in Q1, Q2, that should be the time that people start thinking about dipping their toes, because the risk to the downside is far too great? And even what you're suggesting, 3,000, 3,100, 3,200?
Yeah, I mean, the truth is nobody really knows, right? Tax loss selling, we've done a lot of it already at the beginning of this month for our clients, to be honest with you. So some of that's already being done for institutions. And as you mentioned, a lot of money on the sidelines, a lot of people that are short right now. November, December is traditionally a much better month. If you look historically, October a lot of times is where we actually put a bottom in. And that's the point in time. Being a good investor, unfortunately, is counterintuitive. It's going against the grain. If you're waiting for the news to be good, if you're waiting for the all clear signal, by then, as we know, stocks are going to be much higher. We saw that in 2002. We saw that in 08, 09. You have to buy when there's a little bit of uncertainty if you're looking to get a discount. And because when we say long-term investor, you should have 3 to 5 years minimum. So does 5 to 10% downside really make a lot of difference if there's a potential 40 to 50% upside? Probably not in the bigger picture.
And I completely agree with you. So would you suggest then that perhaps if you are a retail investor, you're not a big institution, perhaps taking on some of these hedged ETF products as your put, and then investing in the long term and just barbelling whatever you have some kind of conviction in?
I think for most retail investors, the problem is they're very emotional. They buy high, they sell low because they think that there's someone that knows something that they don't. What I tell most retail investors is, look, have a 3 to 5 year time horizon. Look at valuations, they matter. And valuations were very expensive. A stock like Netflix that we never owned up until now was very, very, very high. But when you have stocks, good companies now trading at a discount, if you could take a 3 to 5 year average, I don't know that they need to start playing with hedged ETFs that they don't really understand or trying to do market neutral strategies. Buy a broad-based index, buy some of the companies that you can believe in and hold for a long time, and understand there's going to be some volatility. You might not be picking the bottom. Be prepared for 10 to 15% downside. But I think if you buy quality, and you don't need to dumpster dive in a market where everything is on sale, and hold that 3 to 5 years, that's probably the best advice for the retail investor.
And what about the 60-40 rule for having exposure to fixed income, Robert?
Yeah, well, so that's all going to be largely dependent on where you're at. If you're 25 years old, you probably don't need to be worried about that. But what I would say is for the average, maybe someone who's getting closer to retirement, the 60-40 rule now, with the 10-year where it's at, with if you're going to want to have some corporate bonds where they're at, makes a lot more sense than it did a year and a half, 2 years ago. We were just looking at somebody the other day who had a target retirement fund, one of these, target retirement funds, retiring in a year, 2 years, down 21% because no one expected the bond ag to be down 16 or 17%. So I think now that some of that damage is done, we've been steering away from bonds more towards dividend paying stocks. It's probably time to get back towards that 60-40 if that was your mandate going into this.
Robert, this is a great conversation that's helping our viewers navigate through this volatility.